Las Vegas Sands applies for a Hong Kong share offering. The timing and terms have not been decided, but the move was very much expected. Last week, lenders eased restrictions on LVS's Macau credit facility, which would allow share and bond sales in Asia. Billionaire owner Sheldon Adelson said he was considering a share sale. That's to seek funds to restart work on his hotel and casino complex in Macau. Construction stopped last year, if you remember, as credit markets froze. Now, let's get the views of Hans Goetti, our guest today. He's Chief Investment Officer of LGT Bank here in Singapore. What do you make of the timing? Maybe it's not about timing. Maybe it's about need. LVS needs to raise funds.
Well, there's certainly a need. These gaming companies have been hit very hard by the financial crisis, all of them across the board. But market conditions obviously have improved, and it's a great time to come up with a share issue. Markets are up, and I think the timing is good.
But given that gambling companies, gamers, they're still finding the footing, there's still not yet stability, would there be interest in their shares?
We have to make a distinction. I think Asia is probably different from the United States. I mean, Las Vegas has really gone into a slump. I think here in Asia, the conditions are a bit different. I mean, we have more liquidity here. We have asset reflation. Equities are up. In general, things are looking much better here. So I would think that the Asian side of this business should do much better.
It was interesting, if you heard that report from Paul Gordon, he was saying how the various companies adopted different strategies. The foreign players, the likes of LVS, Win, and so on and so forth, they're adopting a pretty much different strategy from what Ho has adopted. Well, what do you take of that?
Well, they probably address different markets. I mean, you have on one hand, on the high end, you have the high rollers, and on the low end, you have the mass market, the no-frills market, basically. And it seems that that's what Stanley Ho is targeting, and that's probably where the growth is in the next few quarters.
Okay, let's take it a step further, Hans. I mean, in terms of the Hong Kong market, how's it looking? We're looking at what a benchmark that has soared 80% since the lows in March. That's too much too soon, time for a correction.
Well, it's the asset reflation story in Asia, and of course that comes on the back of China. You know, China has this massive fiscal and monetary stimulus that leads to very strong growth, and Hong Kong is right at the doorstep. So asset reflation theme, Hong Kong will be the number one, also due to the currency peg of the Hong Kong dollar to the US dollar. A low dollar means higher asset reflation. So I think it's a great theme. Still, we stick to it.
But an 80% gain in such a short time, surely you would see a correction.
Well, you also have to look at the drop that preceded it. You know, an 80% gain, yes, it's a lot. We have seen a correction in China, for instance, that was a 100% move and then followed by a 20% drop. Yes, of course, you see these corrections along the way, but as long as the asset reflation theme is there, we actually stick to the long side rather than the short side.
So if we want to be in the Hong Kong market, what should we be looking at? What should we be buying?
Well, I mean, there's some relatively low risk, high return play, like Hodges and Vanpoa is one of them. That's one of our recommendations. And we would probably banks and financials, property and so on, the whole asset reflation complex, really.
Property, very resilient. Pretty much the same story in Singapore as well.
Yeah, same thing. I mean, it's asset reflation that benefits equities, it benefits property, it benefits everything, really, that has to do with real assets.
And of course, when you talk about China, you know, you talk about commodities. Is that still a buy in terms of the whole industry for you?
Well, I mean, you know, the fear is that China may tighten credit, tighten lending and so on. We don't see that happening anytime soon because China needs growth. What China wants is probably the curb speculation.
But China has been stockpiling, and that's not necessarily the case going forward.
Well, that's right. Of course, they have to diversify out of the dollar as well. So I think it's a hedge against the dollar, and I don't think that will change anytime soon. But as long as you do have infrastructure spending and relatively loose lending conditions, it should be very supportive of commodity prices, at least in the near term. Next year might be a different story.
Okay.